Hey, what's up, my Moose? Mike from the Moose on the Loose. Happy Tuesday. So today, I continue the Brookfield family world tour with Brookfield Renewable. So yesterday, I looked into Brookfield Corporation, Brookfield Asset Management, and today we are looking at BEPC and BEP, two different tickers, same company, same dividend in dollars, yet the yield is different. The performance is different. How could this be possible? As you know, it is quite complicated. So year-to-date return for BEPC is plus 54%, while BEP is plus 35%. While it is exactly the same company, there's absolutely no difference. You have the same rights, you get the same dividend in dollars, and yet there's a huge difference in price fluctuation. And sometimes it's kind of weird because when you look at the price and the total return on a graph, from time to time it will be about the same, which technically this is what should be happening, right? So you're buying exactly the same thing. It's just that one is a unit, BEP, and the other one is a regular share, common share. So the main difference actually is in the demand. So here's the thing. Institutional investors such as pension plan manager or ETFs or mutual funds will not buy trust units or limited partnerships in the US, mostly for tax reasons. And this is also the reason why toward the end of 2020, if I remember correctly, Brookfield Renewable and Brookfield Infrastructure decided to create a different type of shares, which are regular common shares under the BEPC and BIPC, to enable institutional investors, ETFs, and mutual funds manager to be able to buy regular shares of their company. So they pay the same yield, they pay the same dividend, but not the same yield because the demand for those stocks will be completely different. Another interesting fact about BEPC is when it started to trade, it skyrocketed. And as you know, all investors, they look back, they look at the stock graph. When it goes up, they jump in. They don't even think about what it is. They're just like, oh my God, it's going up, so let's buy more. I bought Brookfield Renewable around that time, but it was not for the hype. I wanted to have exposure to renewable energy. This company is great because it targets a mid-single to high single-digit distribution rate year over year, and it actually is able to fulfill this promise for more than 10 years now. So those are the reasons why I decided to buy Brookfield Renewable in my portfolio. But then after that, what happened after 2021? There was like this whole frenzy around renewable energy, completely collapsed, and then it became dead money until recently, like this very year. And at the very beginning of the year, actually, it's kind of funny because I always write a newsletter to my DSR members telling them about the major themes of the year. And for 25, I explained my members how energy and AI were combined and they were linked together, because there is a need for more energy already. And then with AI coming up, several technology companies are inking deal with Brookfield Renewable and the likes. It feels good to have renewable energy to fuel your to power your data center. So this is one of the reasons. And now, there you go, BEPC is actually up 50%. So tomorrow, you're going to have the earnings. Before you jump on this stock, because of course I have it, so you're going to say, oh, Mike has it, so I should have it. Well, you cannot. You can mimic my positions, but you cannot mimic my conviction, right? I know a lot of investors that dropped the ball on this one, decided to say, you know what, it's over. I'm not holding this one because it's dead money for a while. I'm getting rid of it. While right now it's going back on track. Maybe you're going to be interested. So think about the risk first. So among the risk, there are several of them. The main one, besides the complexity of the structure, is definitely how interest rate will play a role on their balance sheet. The thing is, it's capital intensive to build wind farms and solar panels and hydroelectricity power plants, right? So they borrow a lot of money. So when you look at their long-term debt, it keeps on increasing. And there is a double hedge swords here. When you use leverage, well, if interest rate goes higher up, that's going to be a problem. Right now, it's actually the opposite. We see interest rates smoothing down. So that's good news, but keep in mind that whenever interest rate goes up, as it was the case in 22, 23, that is going to hurt their balance sheet, and therefore they're going to make less money. The other thing as well is that they are buying assets, they improve them, and they sell those assets. So that's called asset recycling. That's all sounds great until you buy the wrong asset, you invest more money into it, and then eventually you have to either write it off or sell it at a loss because you're not able to sell it at a profit. So you have to be very careful about that. The other thing, we lived that in 2021, 2022, the trend. Right now, it's super trendy to invest in renewable energy companies and utilities altogether, because that huge narrative, oh, we need energy, it's going to power data centers and we cannot stop building data centers anymore. You have to be careful about that too. Finally, regulation. Of course, they are utility companies. They are dealing with a lot of government with their contracts and so on. So regulations will always have an impact on their business. So tomorrow you're going to open up your press release, your quarterly earnings statement for Brookfield Renewable, and you're going to look at 4 different things. The first thing is, you don't care about the revenue. You don't care about the earnings. You do care about the funds from operation and the funds from operation per share. So FFO and FFO per share. The reason is quite simple. It's a business that is capital intensive. It invest a lot of money into new assets. That creates a lot of EPS fluctuations. So when they are buying, when they're selling, there's amortization, there are integration fees. So the earnings per share is not really the right metric to analyze. It's really the FFO and FFO per share. That will tell you as well the ability of the company to maintain and increase its dividend over time. The second thing to look at is to see if there are new deals. Of course, deals are going to boost the narrative. We had at the beginning of the year, for example, we had Microsoft signing a contract for like $10 billion with Brookfield Renewable. Of course, that was seen as good news. And then the stock price went up. So right now it's a big crave for energy. So the more deals you're going to find in the newsletter, the press release, the more the stock price will go up. So that's even better, right? The third thing is to look if the long-term contract they have, so those are on average 14 years, they continue to benefit from escalator rate. So that's the whole game here, is they have very long-term contract, which is great. It ensures a stability in the revenue, but if you are not allowed to increase the rate fast enough, so through an escalator rate in the contract, clause in the contract, well, then eventually you're going to have pressure on your margin. So far, so good. It's going well, but this is the type of things that you want to see, because the FFO will be influenced by those escalator rate, and will be also influenced if they had acquired new assets in the past few quarters, and now those assets are generating revenue through selling energy. So investing in Brookfield Renewable is, once again, investing in something that requires very patient capital. So if you're expecting a big jump, maybe you're going to be lucky. Like people that started investing at the beginning of 25, they probably got lucky. Good for them. But if not, you invest in a company like this with a very long-term mindset, like more than 10 years, it's probably going to be easier for you to understand that from time to time it's going to be dead money. So the dividend yield is actually pretty good. If you don't really care about total return, you're probably better off with the units because it offers a higher yield. But if you're like me and you prefer total return, because that's what will drive my retirement budget, is the total return, not the income. So I prefer to have the common shares. If you want to know the difference, I do include it with comparison for both Brookfield Renewable and infrastructure into the Brookfield Guide Inside Out. You can download it for free at dividendstocksrock.com/Brookfield. All right, Moose, that's enough for today. Tomorrow we are going to hit Brookfield Infrastructure to wrap up this mini series of 3 episodes on the Brookfield family. If you want to know more or have a better overview, you can go back on my YouTube channel, where I do have a full video about the overview that was recorded last week. All right, take good care, and don't forget to stay invested.